Hello and welcome to a recap of our lecture on IAS 12 looking at tax. We looked at current tax and we looked primarily at deferred tax. So first of all, current tax, remember this is tax payable in the year. So what do? Well, we debit the income statement with the tax charge and we credit a liability because generally speaking we won't pay that tax until next year. So the tax due will be debited to the income statement and credited to a liability for when we pay it later on. The deferred tax then we said was because of differences between the tax rules and IFRS rules. For example, if we have interest that's accrued in our financial statements, interest income, and it's not taxed until it's received in our tax rules, well then what we'll do is we will defer that tax until it's received. So we'll debit our tax with extra tax and we'll credit a deferred tax liability. So how do we go about doing this? So looking at it in detail, remember it's caused by timing differences between IFRS and our tax authorities. The IFRS, really what it does is it requires us to match up the two. So this is the accruals concept at work. It recognises the fact that the tax will be paid eventually and that the profit could be distorted if we don't make an adjustment for that. So we're going to match up the two. We're going to match up the profit per our IFRS to the profit per our tax return. Particularly, we're going to look at non-current assets. For non-current assets, sometimes the rate of depreciation will differ from the written down allowances which are allowable for tax purposes. We match these through deferred tax and we carry the difference as an asset or liability. So how do we go about doing this? Well, remember our question approach. We compare the net book value of an asset in the financial statements to the tax written down value, which is called the tax base. So we compare those two and then we use this table. If there's more asset in our financial statements than there is on our tax base, so if we do our net book value in the financial statements and it is higher than the tax base, well then that means we need more tax. So we debit tax, credit deferred tax to create a deferred tax liability. If there's less asset in our financial statements, i.e. the net book value is lower than the tax written down value, then we need less tax and that would create a deferred tax asset. Credit tax in the income statement, debit a deferred tax asset. So you needed to learn that table. So remember the difference between our net book value and our tax base multiplied by the tax rate would equal the deferred tax asset or liability required. And we went through a detailed illustration of this in illustration 1 to see exactly what this meant. So the key points on this were that step 1, you first of all compared your net book value to the tax base. You multiplied the difference between the two by the tax rate. And that is the balance on deferred tax in our statement of financial position. So the next thing was we needed to decide whether it was an asset or a liability, and we simply used our table to do that. Now the key thing was if there was already a balance on the deferred tax, the movement between the new balance that we've calculated and the old balance brought forward would go to the income statement. So step 3 was to deal with that movement in deferred tax by adding or subtracting it from the tax charge in the year, depending on whether it was a debit or a credit. And we did that in illustration 2. So finally, some key points on deferred tax. Deferred tax could be created through revaluations. So if you think about it, a revaluation may affect the net book value but not the tax base. So that would create more deferred tax liability. So rather than taking this to the income statement on a revaluation, the entries will be debit the revaluation reserve, credit deferred tax. So rather than debiting the income statement, if it's a revaluation, we debit the revaluation reserve. Lastly, do note that if you have losses, income tax losses, we can carry those forward as an asset. If we expect that we can recover those losses, i.e. if we expect future profits that we can set those losses off against to actually reduce our tax liability, but only if we expect to be able to recover them. So that was a recap of our lecture on tax, covering current tax and deferred tax.